Jason Bellevue. I am the current president of the California Association of Mortgage Professionals. Thank you for joining us this afternoon for some reverse mortgage education. I will tell you, in today's environment, you need to know how to do everything. And reverse mortgages are a wonderful tool that you can have as part of your complement that you can offer to your business partners and the people that you do business with. So let me introduce Chris Munson. And Chris, why don't you tell us a little bit about yourself, and we'll get started.
Thank you, guys, and thank you everybody for taking time out of your schedules. I know we're all busy, and certainly the market has been interesting the last really 72 working hours, but especially the first 48 of this week. So thank you again. My name is Chris Munson. I'm the Senior Vice President for the Money House. We are a wholesale reverse mortgage lender. I personally have about 23, 24 years in the HECM space, reverse mortgage space. I've been in the mortgage business longer than that, but I really found I liked the product and kind of went to it years and years ago and have stayed with it. So, it's a growing product, obviously. And as Jason said, truly, as a mortgage broker or an originator, ultimately the goal is to convert as many prospects that come across your desk. So this is just another way to help a segment of your prospects do that. And one of the things I'll start with on this really is, everybody thinks reverse, okay, thinking of the 75-year-old retiree or the 80-year-old retiree or what have you, widower. That's true. But think in terms of prospects, people that might be potential referral sources for you. And I say this, are a lot of your mid 50s or even younger than that, folks that are dealing with their senior parents. There was just a study released right at the first of the year talking about the strain on what's called the sandwich generation. That's the generation that's having to help their parents who are retired with either financially, or as we'll see in this presentation, a lot of it's caregiving or planning, because the parents are living longer, which is a good thing, but there's more and more seniors coming into the retirement age. And actually the fastest growing segment right now is folks turning 65, not turning 62, 65. So, what I'd ask you to do is, the old notion is, I don't have any senior clients. Well, that's true. But how many 54, 55 or older clients do you have? Because they're probably dealing with parents and they're more involved than they ever thought they would be. So hopefully that's just a little tip to get you thinking about it, because we found in our business, talking to a lot of loan officers, they're how do I market for reverse? Well, it's no different than what you do for your regular business. It's just a little different clientele. So a little bit about what we're going to do, and I take about 35 minutes with this. So obviously any questions, I'm happy to answer, but there's some good information here. Some of it is stuff you've probably heard before because the product is the product. I will touch briefly on, especially since you folks are in California, the difference between the FHA product and the proprietaries that are in the market, because proprietary is something, especially where you all are in the state you're in, the proprietary does play a role and it is gaining traction. But let's talk just a little bit about why offer reverse mortgages. The old adage of 10,000 Americans turning 62 each day, you've probably all heard. To be honest with you, as I said earlier, it's actually over 10,000 Americans are turning 65 each day. So we are into the real, massive movement of the retirees, of the baby boomers. They're aging. Most of them are homeowners. Again, it's over 44% still have a mortgage. and over 68% are homeowners. The current available lending equity in senior held households sits at about 14.3 trillion. This slide says 14. It's actually higher than that at the end of the year. That's as of December. 17% of seniors that have a mortgage say they'll never see it paid off. That's very true. Actuarially, it's true. But the other side of that is, and I didn't have it here, but I just, as of December, I had the statistic from MBA that 41% of Americans have no mortgage on their home. That's, it's hard, at least I think. We're in the mortgage business, so we're dealing with clients that are taking out mortgages for whatever reason. But 41% of Americans do not have a mortgage on a home. So there is a whole lot of loanable equity sitting in a group of people that's living longer, that is financially stressed, and an environment that is going to continue to stress that financially. So 78% of households age 65 own their home. That's, again, about 14.3 trillion in loanable equity in the 65 and older bucket. The other part that I really want to highlight is, every year over 350,000 seniors purchase a home. That's your realtors. You can use a reverse mortgage to purchase a home. And as an industry, it's been a small number of our overall endorsements. We've had some success growing it, but I think it's really the hidden gem in the HUD product, because you're already talking to realtors. It's a natural referral source for loan officers. So why not talk about it? Especially if you're in an area with high relocation or a high senior concentration. A lot of senior communities are being built in a lot of parts of the country, and I know many of them are in California, the age restricted communities. So that's a natural. The other thing I'd like to say with that is, buying a house for cash is great, right? Great. A lot of equity in a house is great. Looks great on a piece of paper. But as always, there's only two ways to get money out of a house. You either have to borrow it or you sell the house to liquefy it. So, if you can't get the money you need, even though you've got the equity, all that equity really doesn't do you any good, especially with housing costs if you have to sell and relocate. So just a couple things there to put in your mind. Why hasn't the reverse product taken off more? My biggest belief is it's a lack of knowledge, product education to the brokers. The monoline reverse mortgage companies that have the call centers that run the ads, or they have field sales, those guys do a lot of loans. Our contention is, because we know from our own portfolio statistically, the brokers that write reverse mortgage loans, the consumer gets a better deal. And the consumer prefers, by and large, to deal local if they can find somebody that can help them. So that's kind of again, we've been on this kick, if you will, for a long time. But, our whole reason for doing this piece is we just want more brokers involved. Whether you write one loan a year or you do, whatever a month, if you find you really have a niche for it. But even that one loan is a better deal for the consumer, and it's one more reverse mortgage written by a broker. And by and large, if you do one and you have success with it, you'll probably look for more. Compensation-wise, they're very attractive. So, again, a lot of opportunity there. Again, talking about purchases, talking to realtors. You do it all the time. Financial planners. Financial planners, we have seen, again, some increased success in referrals from financial planners as an industry. And the reason being is financial planners had to adjust their models to include real estate as part of the income stream, because it's a reality. So again, it's all about, can we have you all, or more of you all, looking at reverses and being involved in the product, rather than just saying, it's easier to hand them off or what have you. The other interesting part is, and some of you in different parts of your markets may have run into this. This has to do with equity release products. Now, yes, that does include HELOCs, HELoans, but it also involves these equity investment contracts, or there's a couple other names for them that are out there. There's companies that have, we've seen more and more of those. But the estimate is equity release products to grow 35 billion in the next 10 years, because obviously there's a lot of equity, and most of that will be HELOCs and HELoans, or first lien equity products, but also some of the smaller market participants now, and some of those products have actually tried to look to the consumer like a reverse mortgage, but they're vastly different. Broker participation, again, we just haven't done a good job of getting more brokers involved. On average, in any given state, now California is a little different. It runs a little differently month to month, but on average, brokers account for less than 20% of the loans originated each month. So you've got your large monoline reverse mortgage call centers doing the bulk of the loans. So, and we do know from MBA studies over the last 5 years that seniors prefer to age in place. So it's a growing demographic that wants to stay in the home as long as they can financially and physically. It's just a question of, can we reach more? And that's the growth of you all, the mortgage broker. So like I said, ton of opportunity. A little bit about us. We are a company based in San Juan, Puerto Rico. Our U.S. operation is headquartered out of Orlando, Florida. But we are Puerto Rican owned. The family that owns us is Puerto Rican. We are one of 8 active Ginnie Mae issuers for the HMBS, which is the HECM mortgage-backed security. It's just the HECM version of your MBS. It's, again, one of the other things I'll say is we do have an MSR population that we own. Because of the Puerto Rican piece, we do have the ability to help consumers or mortgage brokers who prefer to speak Spanish. We have a bilingual staff in Orlando. So I myself am not bilingual, but we do have a staff that can assist. So if you run across that and, again, if you don't speak Spanish and you've got a potential Spanish prospect and you need help with that, that is one of the neat things we can offer. It is only English or Spanish. We get asked for different things from time to time. I have enough trouble just with English and Spanish. So, but the other thing, again, like all of our competitors, we give you a seat into our LOS as an approved broker. But one thing, if you don't do reverses regularly, or if you haven't done them in a while, these loans do not get originated out of your traditional forward systems. So your Encompasses, your Calyx Points, and some of the others that are out there, they don't originate reverse mortgages, okay? So one of the things that we find a roadblock that we try hard to educate and help with is you have to use one of, right now there's 3 LOSs in the reverse mortgage space. We happen to use a system, our proprietary system is called Rex. So if you can use one, you can use them all. I'd say if you can use Encompass or Calyx Point with the milestones, you can use a reverse system, because believe it or not, we don't use a lot of the milestones you have to use in the forward space. We don't even use TRID. We're still the old-fashioned HUD-1 and good faith estimate. So, but we do find loan officers sometimes it puts a roadblock up because they're going, I got to learn a system. Well, not really. Number one, it's not hard. Number two, we can help. But it is something to mention as part of it. Again, are you missing opportunity? I would say for the vast majority of you, yes. Over the course of your year, you're missing opportunities to write a reverse mortgage. Now, many of you may, you know them, you do them, and that's great. But the vast majority of brokers just, statistically don't. And if we are at a trade show, and a lot of times we'll ask folks, do you do reverse? Have you done one? They're like, nah, I've got a loan officer I know who that's their specialty. I just hand it off to them. Well, okay. Personally, and I think it's great if you're that busy, but if like a lot of folks, your business tends to ebb and flow throughout the year. Why not get another loan, especially when your lender's going to help you. What we're talking about here is the FHA. Okay, so the HECM. It's not a new program. It's actually been around since 1989. Simply put, it converts equity borrower, a percentage of the borrower's equity in the home into cash. It is a refinance product, obviously, if they already own the home. It does allow borrowers to buy a home with a reverse mortgage. It's very user-friendly on how the senior elects to get their money. Very user-friendly, and it has some unique options in there. And the biggest one is, again, at no point is the borrower required to make a principal and interest payment. Okay, they still have expenses. They have to pay the taxes. They have to keep homeowners insurance, flood insurance, etc., if it's required. But they must keep the taxes paid current. It's got to be a primary residence. All reverse mortgage products, whether it be proprietary or the HUD, are going to be primary residences. Okay, so there is no product in the market whatsoever for anything other than the primary residence when it comes to a reverse. But that no monthly mortgage payment is huge cash flow to a lot of seniors. Basically, when it comes to what type of properties, if that property fits HUD's guidelines on the forward side, it fits on the reverse. There is no difference. So that's a positive. The only negative is, yes, it's still a HUD product, so you do have the condo issue. Proprietary products use Fannie Freddie approval processes, or if they're Fannie Freddie approved. So that is different. But for the HUD product, because it's FHA, yeah, we got to deal with the condo if you're in a high condo market. Some of you are, most of you aren't, but it is an issue.
Chris, I apologize. The slides are not moving forward. I'm not sure. It's still on the very title slide.
Okay. Sorry.
No, it's a.
Let me see here. Hold on 1 second. Oh, so let me see why I've got the technical difficulty. I spoke too soon. Let's see. Where's the Zoom? You know why? Okay, hold on. 1 quick second. Share. 2. There we go. I apologize, everybody. I wasn't aware. Somehow or another it got off. Anyway, so again, features and benefits. If the property meets HUD's forward guidelines, it meets the reverse guidelines. Okay. Borrower safeguards. The biggest one is with the FHA insurance. Of course, these are non-recourse. At no point does the senior nor the estate ever owe more than will be due than the house would sell for. Okay. The proprietaries also have non-recourse clauses, but they are proprietary. So we've been in good markets. We've also been in bad markets with proprietary products. They have some inherent risk in them from a market standpoint, but they are non-recourse as well. And essentially the non-recourse means it doesn't matter if the senior sells the house, their estate sells the house. If that house doesn't sell for enough to cover what's owed on the loan, they don't know it. There is no deficiency balance the way there is in the forward world. So that's non-recourse. The senior has, again, I said, it's very user-friendly. It's the most user-friendly product in terms of payment options, how the senior chooses to get their cash and when they want it, how they want it. These are all things that HECM really, truly is user-friendly. And it's far more user-friendly, again, kind of separate the proprietary from the HECM. Proprietary's a little more, it's either a fixed product or a limited line of credit, whereas the HECM is the line of credit features are a little more robust than the proprietary. So that's just to separate them a little bit. Let me also put, at no point on the HECM product do FICO scores come into underwrite. These are manually underwritten. There is no AUS system for them, but FICO scores do not affect pricing. They do not affect how much equity the senior gets. It's not a part of the underwrite. Okay. Borrower eligibility, again, talking about the HECM or FHA insured, it's the minimum age. At least one of the borrowers must be 62. On the proprietary products, you do have a couple products out there that go to 55. But for the HECM, you're dealing at 62 or older for at least one of the borrowers. Obviously, it's an FHA appraisal on the HECM product. The current expected interest rate for calculation. So essentially what you have is an age equity rate calculation as to how much money the senior gets. It's almost like an actual, well, it is an actuarial. A 62-year-old is not going to get as much money as a 90-year-old, simply put, because the 62-year-old has a lot longer in that house from a life expectancy than the 90-year-old, and you have non-recourse. So, over the course of if you've been in this business longer than 10 or 15 years, you've experienced what a market's like with negative equity, or houses selling 20% below what they were bought for. So we know this can occur. We've been fortunate for quite a while, but I guess it's more like probably the last 15 years that we've been in a fairly, static market when it comes to equity. But that possibility is there. Thus, that's why you have the equity positions being like that from an actuarial standpoint. The qualifications, we do have to underwrite the loans. We underwrite on the ability to pay. It's not a DTI, it's residual income. If you do VA loans, same tables, same exact tables, save the fact that the HECMs are just slightly higher in the monthly amount. I think it's, last time I checked, it was about 5% higher in what the residual income required was, but they're the same exact VA tables. Willingness to pay, we have to review the credit history. Again, credit scores do not impact, so it's a manual underwrite of the trade lines for the last 2 years. And again, no FICO score. And it is, let me back up, it is a federal loan. It's an FHA loan. So if you have IRS liens or other federal debts, that can preclude or require them to be paid prior to closing or as part of the loan. Just an FYI. Property types I don't spend a lot of time on because, again, if it meets HUD's guidelines in the 4001, there's no difference between a reverse and a forward. It meets, it's an approvable property type. There is a counseling protocol. The borrower must do counseling. The borrower must choose the counselor as part of the pre-qualification process, or quote process, as we call it. A list of counselors is given with the estimates on how much equity they could get out of the property. And the borrower in California and most other states can do telephone counseling. There is a charge. Most counselors these days are charging $125 to $150. The borrower must pay it. It cannot be paid by the lender. It cannot be paid by the broker. It cannot be reimbursed. It has to be a borrower paid item. That's a HUD requirement. Now, the counseling agency can reduce or waive the fee at their discretion. So that's between the borrower and the counseling agency. But from a standpoint of, the only people that can pay for counseling are the borrowers. If you're using you're using it for a purchase. We have standard purchase contract. You do have the HUD addendum. The HUD addendum for a HECM is slightly different than the FHA HUD addendum, but it's basically the same. And of course, you've got a FHA appraisal. If you're doing new construction, the CO must be issued prior to closing, no different than your forward flow. But a few of these are modernizations. The CO issue, we just got that a few years back. It used to be the property already had to be done and the CO issued before you could even start a reverse. Nowadays, at least it's more modern. And we're working every day through trade associations, including NAM, to try to help modernize FHA in a word. And part of that certainly would be, a piece of that would be the HECM. Common myths. Some of you may have them. I will tell you, it's amazing, having done this as long as I have, that these are still out there, but they are. So, the biggest one is the bank owns my home. False. And I say this figuratively because there is no title transfer. This is a loan. The borrower who owns the house is still the borrower and the owner. This is just a lien on title like any other loan. They are very expensive. False with a caveat. The caveat is there is an upfront MIP on these loans. Okay, on the HUD product. That is 2% of the value of the home. We do not use county lending limits for HECMs. We use a national lending limit. And our national lending limit is $1,249,700 750, I think. So that 2%, no matter the loan amount, the 2% is charged on the value of the home up to that maximum lending limit. So $1 million home, that's a $20,000 MIP paid to HUD. It's financed as part of the loan, but it's real. The proprietaries do not charge an upfront MIP. So there is a difference there that can make proprietary more attractive than the HUD product. Now, there's some other limitations in there, but that is one there. Again, we are working, like everything, with HUD to try to reduce that in certain cases. It's an ongoing thing. It's DC politics, so who knows what success we'll have, but it is an ongoing issue we are trying to work with HUD on. But for now, it's still the 2% across the board. The children or estate will owe money. Again, they're non-recourse, not at all. My benefits, there is still some misconception that somehow or another a reverse mortgage would reduce benefits or put some forfeiture on benefits. And it's not true. It's borrowed money, so it's not income. So really, we've run across historically a few instances where a borrower is getting some sort of needs-based program. Now that could be a thing, but if it's your standard, and it's non-taxable money because it's borrowed money, so it's not income. So that's true, or excuse me, false. The other thing I'll put here is there is a misconception, again, talking about some of the home equity investment contracts or home equity investment agreements that have come out. Those products tend to, and some of them have been masked to look like reverse mortgages. And I'm not saying that negatively. I'm just saying that's what's happened. So they don't have a monthly payment. Those products don't. But they have shared appreciation at a certain time in the future. That's how they make their money and get paid back. That is not a reverse mortgage. These products, neither the HUD product nor the proprietaries have any shared appreciation in them. So I just want to make sure to separate that, just in case you've seen it, run across it, or had a product marketed to you to sell that looks like a reverse mortgage. But if it has shared appreciation, it is not a reverse mortgage in any form or fashion. So I just want to make sure we're clear on that. Baby boomer housing wealth is at historic high. Again, this is 14 trillion. It's actually 14.3 trillion as of the end of December. So there's a ton of loanable equity sitting in properties, which there are in most properties. But again, we're going to talk about why that's really impactful for seniors. We talked about financial planners being more receptive to reverse mortgage solutions. It's because real estate is becoming a necessity as part of a retirement plan. It absolutely is. We know, again, seniors prefer to age in place as long as they can financially and health-wise. They want to stay in the home as long as they can, or buy a home that's more stay-friendly for them. Again, we all know the retirement crunch, and there's articles every day. I get them every day, and I try to save them. But they're all about, seniors, even seniors that have planned well, are one major life event from not having planned well. And that's true of us working adults as well. But it's really impactful for a senior because their income doesn't do this. Their income is here. This is it. The more they have to draw from any asset basis on top of Social Security or pensions or what have you, that just reduces that amount of money for their future draws. So a senior, their margin for error is far less. Hence, financial planners are using real estate as a bigger component of it because it's like I said, it's just a reality. It wasn't really viewed that way in the senior retirement planning 15 years ago. But boy, it is today. So change of circumstances, unexpected life events, these are all critical things for a senior financially and can be devastating. The other part that is really, and I sat through a session on this about a year and a half ago. So I was like, I hadn't thought much about it. Shame on me, even being in the reverse mortgage field. But part of living in their home. Seniors want to age in place, right? Well, there's a whole cottage industry built around this, the aging care. Many of you have seen Visiting Angels, A Place for Mom. Oh, Lord, there's probably 6 or 7 different in-home assisted senior living services out there. And most of those people are franchisees, by the way. Again, a marketing tip. If you see them or have one in your area, or if you're in a Chamber of Commerce or a Leads group or something, and you have somebody from one of those in there, I encourage you to strike a conversation up with them, because most of those are self-pay. Most of those are franchisees. So they're business people just like you. And they're trying to help more customers more ways. So, and one of the biggest ways is how they pay for it. So, the occupation of a caregiver is expected to grow by 34% by 2029. That's huge. It is one of the fastest growing rates of all jobs in the United States. This is from 2020, late 24, there were 482,884 home care providers in the U.S. That was a 3.7% increase from 24 to 25. It's projected to go even higher as we move. Again, more folks turning 65 than 62. So it's an aging demographic. The shortfall, the caregiving shortfall, cost-wise, okay? The annual cost of a daytime caregiver is $45,750. This is average, obviously. $137,000 of a round-the-clock caregiver in the home. So the value of unpaid care nationally is estimated at $450 billion. Unpaid care. So you think, well, unpaid care, what does that mean? That means people that instead of hiring people have family or friends or someone close to them is providing care or a portion of the care instead of paying for it. So 43.5 million number of family members providing unpaid care in the United States. And that's a 24 number. So I have not seen 25 yet, and I will update when I get. But that's 17% of the workforce in the United States is providing care. Again, 24 numbers. 50% of the caregivers who feel they have no choice but to provide care to family, they can't afford to pay for it or pay fully for it. So they're having to provide care, supplement the care. And of course, a lot of times that's the spouse, but a lot of times it's kids, grandkids. 52% of Americans over 18 who expect to provide care to a relative in the next 5 years. That one, I will tell you, that's much higher in the mid-50 range. Now that I use that loosely because care could be financial assistance. It could be, actually helping take care of a family member as they age in their home, or multi-generational households. We have seen in certain parts of the country swings where folks are buying houses with more inclined in-law suites and such like that, or buying duplexes or tries where a family member, parent per se, would live in one and the owner would live in one. And that's part of that. So we are seeing some of that. I can't say it's prevalent yet, but we are seeing it. The funding shortfall, again, 50 million Americans receive in-home care, with the vast majority being informal care. Again, spouses, children, extended family, friends taking care of them, or a combination. Most receiving this care are over the age of 65, and that population group is expected to grow to 73 million by 2030. So a large swath of the retirees are going to be over 65 in the next 4 years. And again, this massive expansion is just fueling growth for the folks that, their businesses that send home care. It's a huge issue. They can't find people quick enough, and they're having to pay really high wages for the ones they get. So it, like a lot of things, no different than healthcare, right? There is a strain in that, and it's just because so many Americans are aging. But it is again a business. So really quick, the prospect. How do you know if a prospect is a good prospect for a reverse mortgage? Obviously, the age. If you're looking at the proprietary, the youngest is 55. If you're at the FHA product, it's 62 is a minimum age for at least one of the borrowers. What are they trying to do, and does the reverse give them enough money? If the reverse doesn't give them enough money from the loan to accomplish what they want, 99% of the time, that means the reverse just isn't, it's just not a good option right there. Now, if it does give them enough money, it doesn't mean it's the best option, but it means at least it funds what they're trying to do. And that's done basically with a quote. And a quote, the beauty of it is, I don't need to know FICO scores, any of that. All I really need to know is the age of the youngest borrower, what's the value of the home or estimated value, how much do they owe on it? Those three things, right? Now, I still have to get zip code of the property, and I think the city of the property, just for the quote, the way the LOSs are built. But it'll tell me the numbers, estimated numbers. So I've got a pretty quick way to say, hey, all right, or this borrower isn't right for a reverse. Or again, with the proprietary being more and more prevalent in the market, you know, sometimes I can pull a quote for a HECM, and that borrower just, you know, it's not enough money with this product, but the proprietary gives them enough money. So that's the benefit of having both sides of the business right now. You have more options than just the HUD HECM. But again, you know, they're two different things, and there's benefits to both, and there's some drawbacks to both. But it's very quick to determine if the money works. Now, again, that's not saying that means it's the best loan. It doesn't mean the borrower should do a reverse mortgage. It just means it's a possibility. So then the counseling appointment, the session, and these are HUD-approved counselors on the FHA side. So they have a protocol as part of their counseling that they go through with the borrower. It's not a pass-fail. It's not a, oh, that's a terrible thing, don't do that. But it is a protocol gauged by HUD. The other thing I'll say is from an originator standpoint, the more you're able to answer questions or prepare the borrower for what counseling is like, or if you're telling them accurate information, the more you are deemed professional, because all the counselor is doing is verifying what you've already told the borrower. Okay, that's always been the case, but even more so now, because again, you know, and it doesn't mean you have to be a subject matter expert, but what it means is if you know the ABCs of the product or can get that information to give the borrower, that can separate you from a lot of originators who try to do a reverse but really aren't that well versed in the product. But again, I don't believe, and I will tell you my years of experience tell me you don't have to be a subject matter expert to originate one of these loans. So the next step for the prospect, again, pre-qualification. That doesn't mean credit score, credit review. It means, does the equity position work? Counseling. Again, most states are telephone. There are a couple states that are in person only, but it's not California. California, let me say, is a state that does have a counseling restriction. In the state of California, you cannot order any services until a 7-day cooling off period has occurred between counseling session. You can take the application, borrower can do counseling, but you can't order a case number or any appraisal title and that stuff until a 7-day cooling off period has occurred. If you do reverse, fine. If not, your lender, whether it be us or our competition, obviously, will tell you we can't order the case number yet. The cooling off period is there. And it's also noted within the counseling certificate and accompanying paperwork from the counseling agency. Again, we offer processing. Obviously, there's underwriting. It's a manual underwrite. It's pretty, you know, there is another misnomer out there from a lot of folks. These take a long time. You know, no. Our average from submission to close is 21.4 days in underwriting. Submission to close. We have loans closed in less than 15. Okay. The misnomer of the fact that it takes longer is because, number one, you're dealing with a senior whose motivations or diligence on a loan may be longer, or you may have family members involved. And number two, you do have the counseling piece. So, you may talk to a borrower and it takes them 3 weeks to get around to doing counseling. Okay. Can't really do anything in a 3-week period. So that, in my experience, is why people think it takes long. It really doesn't. Once they've done counseling, it's a month. There's an application, gather documents, submit to underwrite, get your case number, submit to underwriting. Underwriting approves, clears conditions, you close. Again, we're 21.4 on our pipeline. So closing and funding, no different. And then servicing. Servicing is a little different because obviously the borrower is not required to make principal and interest payments. But from a servicing perspective, the borrower gets a statement every month. Every month they know exactly what's going on with their reverse mortgage. All the servicers now, ours included, they all have websites. The borrower registers for a website. They can go in and electronically see anything they want. They can make draw requests electronically these days from their lines of credit. All of it. So while I'd say from a servicing perspective, they're still a little clunky because you still have the fact there are no payments received, and it can be a borrower wants to make a payment. Even with our servicer, the process isn't as great as it could be, but they are working on modernizations for that too. But truly, again, it's a servicing mechanism. So, it's a mortgage. That's all it is. There's some odd reason people think they're hard. They're not hard. They're just different. But it's still just a mortgage. So, final thoughts. Again, why are we doing this? We're doing it because whether you do one loan, like I said, one loan a year, that's one more loan done by a local broker. We know in our portfolio from just analysis, a brokered loan versus a call center loan is usually a better loan for the consumer in rates and fees. Okay. Plus the consumer now has somebody local and you have another referral prospect. Seniors have kids. Kids usually have senior parents. So it's that, not just a reverse mortgage. It's another prospect to refer business to you. And again, remember, no required monthly payment always increases cash flow. So again, we appreciate the fact you took time out of your busy schedules to join us today. We appreciate Camp for allowing us to do this. We really try to be there to help, again, brokers enter this space as best possible.
And I appreciate that very much. And I've also got a couple of questions for you myself.
Sure.
One is we hear about jumbo or reverse products. So I wonder if you could speak a little bit about those, the differences, so on and so forth. And then there's lines of credit that you can get with a reverse mortgage as well. And the line of credit's an interesting concept because I'm going to throw a little testimonial in here. I have a client who is a hairdresser, self-employed hairdresser that I put into a reverse shortly, like a year or two before COVID, who every time I talk to this woman thanks me for her reverse mortgage because she'd have lost her house during COVID because she couldn't work. And she also got a line of credit in her case with it and calls me up every time she needs to use it for something. Because she keeps getting her statement and seeing how much it's grown and calls you up and goes, I need to buy a new heater. It's going to cost me $5,000. Is that okay? And I'm like, it's your money. Of course it's okay. But she loves the fact that she's got the line of credit as well because it becomes something in her case that is a fallback if something goes wrong. So I was wondering if you could talk a little bit about both those aspects of things.
Yeah, very good. Two great questions. All right, so what I've been referring to as proprietary is exactly that. Most folks call them a jumbo because they're really designed to pick up where the heck 'em leaves off, right? And again, in parts of California, Dale, where you are, it's hard to find a $1.2 million house. So you're talking about houses that are going to be in that 2, 3, and up range. Well, seniors still own those houses and they still have needs of cash. So when I use proprietary, it's because most of the products are very similar, but they do have some nuances depending on the investor, because those are investor specific who are either securitizing themselves or selling them to another investor. A commonality is, again, most of them will not take a property less than, when I say this, this is a thumb, but usually properties less than 600,000, they don't want. It's not a proprietary. The HUD product is better for those properties. So as a rule, you're moving up the curve, million plus type value to really make the proprietaries worthwhile. They are higher rates because it is a proprietary. So you're looking at the spread between a HUD HECM today and a proprietary being somewhere in the neighborhood of 250 to 300 basis points higher on a proprietary. The fixed are running about an 8.99 in that range, whereas your HUD product right now normally is about a 6.25 this week. To the line of credit, there are limited lines of credit in the proprietary world. Okay, some of them do have them. They are limited. Some of them have draw limitations, how many years you can draw. They don't have compounding growth the way Jason was talking about. The neat thing with the HECM product, especially the line of credit, and this is another one that the financial planners are buying into. The line of credit on a reverse mortgage that's established grows every month in available credit. It's not interest income. For some odd reason, there was some confusion on that. But it grows in available credit every month automatically. So the unused amount in that line of credit will always grow at a 0.5 percentage point above what the note rate is on the loan. So again, if you had a 6.5% note rate, that line of credit's growing at 7% every year, every month. And it's compounding monthly, growth on growth on growth. So one of the things we have seen financial planners buy into really is a 62 or 63-year-old who has essentially a ton of equity in that house doing a reverse mortgage now, even though they're still working. But it is an emergency fund. They don't have to go looking for money if something comes up. But also on about a 63-year-old, if you're sitting there with a note rate of somewhere between 6.25, 6.5, plus the growth rate, that line of credit is going to double in approximately 10 years. So a $100,000 line in about 10 years will be a little over $200,000. So that is a concept financial planners love. Seniors love it because, as Jason said, COVID, prime example. A lot of folks couldn't work, or a lot of seniors that were working part-time to make ends meet couldn't work anymore. That's a chunk of their income. So that line of credit can be a lifesaver. It also can be, again, that whole build. I'm going to use the term, kind of like an insurance policy. It's not, because obviously it's a line of credit. It has no maturity. Let me backtrack a minute. When I said there's differences in the line of credit products between the proprietaries out there and the HECM line of credit never matures. It is in place and growing until the last homeowner leaves the property. Okay, even if you have two borrowers, one of them passes or moves out, that surviving borrower always has access to that line of credit. Never changes. Most of your proprietary lines of credit freeze after 10 years. Okay, and they don't have the growth factor. So those are a couple subtle differences. But yeah, Jason, great insight, because it's absolutely true, and it can be a life changer for folks.
No, absolutely. And you talked about the myths earlier. Of course, being an older hairdresser, she was very focused with older clients. And I think every week some client came in, he gave her a myth I had to talk to her about. Mm-hmm. It was really funny. But she loves it. And I've got other clients I've done reverses for that it really has been a wonderful tool for them. And like I said, in her case, she knows it saved her house. She wouldn't have that house otherwise.
Yeah, it's like I said, the satisfaction rate on these things from the consumer standpoint is a little over 97%. The trade organization for the reverse mortgage industry, they monitor that like clockwork through a third-party service. And, so like I said, it's a great product. Now, like everything, it's a mortgage product. No mortgage product is right for everybody, even if the numbers work. So it's still situational. But for those it's right for, it's a great product.
Well, and there was a question, and I think David might have been responding to it, but there was a question in there regarding certifications for reverse mortgages. And I'm not sure if you responded to it, David, or not. It's kind of hard, as you can see. I'm kind of mobile right now. Unfortunately, something came up, but we know that. Go ahead.
I was just going to say I'll go through the questions. That way we can certainly address that, and some of the others I kind of pushed to the back to this part of it so we can clarify some items.
Absolutely, please do.
Yeah. Well, first was more about Money House than the product itself. Do we do processing? And as Chris said, we will process for you. At this time, we're processing and doing all the normal processing tasks. But anything needed from the borrower, we will typically push back through the originator and let them be face forward with the borrower to get those items. We were asked about the second mortgage reverse, which we as a company do not offer. I believe it's still out there in the industry.
Yeah, let me that is a product now. There's a couple new products that they call them HELOC for senior, and there's another one that are second liens, but they're not reverse mortgages. Okay, they have traditional qualifications. They have payments. They can be interest-only payments, but they do have payment requirements. There is only one true, and I don't mind saying it because they're the only one in the industry. Finance of America has a true second lien reverse mortgage product. They are the only entity in the marketplace that have that. So that's Finance of America. If that specifically is what you're looking for, far as your home for that one, they're the only ones that have come out with it. So.
Yep. Another one about the slides not moving. We'll move past that one.
Sorry about that.
Don't worry about it. Do you have a condo approval department for HECMs? I have had a couple clients with over $1 million condos that aren't FHA approved. So, again, our product, the product we offer is the HUD product. So it either has to be in the HUD approved list or be able to do the single unit approval process, which doesn't mean there's any shortcuts. It just means you're not getting the entire complex approved.
Right.
The best thing to do there is to get us, me, whomever the technical official name of the condo, not the name that's on the sign, but the actual recorded name of the condo. And I can look it up for you and let you know if anyone has made any attempts to get it approved, or if it's just simply been denied. And if it's not on that list, we can go through what we will need in order to do the single unit approval. And there's some key questions that you want to get answered by the HOA management that if unfortunately if they answer them a certain way, that means HUD will not do a loan there. But that's where these proprietary products that are out in the industry will help you a little bit, because they will do some condos that HUD will not do. So non-recourse is the negative equity position on insured. Is the negative equity position insured to the point where the owner or estate will only be liable up to 95% of the value or sales price?
Yes.
Basically, go ahead.
No, that's exactly right. HUD does build in a cushion for the borrower. So yes, that there is. It used to be 97, now it's 95%. But yeah, at the end of the day, the best way to think of it is it doesn't. If it's negative equity and it's the HUD product, I'm going to deal with that one. There is non-recourse to the estate or the borrower themselves. Some folks seem to have a misnomer that means the estate, both borrowers are deceased. No, it also protects the borrower. The borrower selling negatively or undervalue, there is a short sale procedure that has to occur. It's standardized. It's not, it's an approval process by HUD. But yes, the non-recourse is absolutely in place for the borrower and the estate.
Yeah, and where the benefit also is, if one of the heirs wants to acquire that property, could be a legacy property, could be the one they grew up in, or whatever the reason. If it is upside down, they can acquire it for 95%. Well, they don't acquire for 95%. They pay off the HECM at 95% of the market, the appraised value at that time, not when the reverse was done initially. but at the time they're transferring the property. Up to what age is the loan good for? Basically, as long as the borrower occupies the property as a primary residence, it stays in place. There is some language in the mortgage that it's due when they turn 150. As of right now, I don't know that that's going to be an issue for anyone, but I believe that language still exists in the mortgage or the note somewhere. But basically, as long as they occupy the property as a primary, keep the taxes and insurance up to date, keep the property in acceptable condition, the HECM continues.
Right. And let me also add, I didn't touch on it here. One of the other modernizations we did get some time ago, it's called a non-borrowing spouse. So minimum age for the FHA product is, and again, a separation between the proprietaries and the FHA. Some proprietaries do not allow a non-borrowing spouse. Okay, so that's problematic. But for the FHA product, non-borrowing spouse can be younger than 62. They maintain lifetime rights to the property as long as once the borrower is deceased. They maintain lifetime rights to the property, again, as long as they do the required items. And that's another piece that financial planners and estate planners have really begun to like, because it essentially acts like a ladybird deed. Okay. The spouse can be on title. They get the property, don't have to probate the property. Okay. So that's another separation of the two products, but also a modernization that's there. If you have we see it. We see 70-year-olds married to 50-year-olds. I mean, again, I'm not saying that, but so that non-borrowing spouse is a function of the FHA product.
Yeah, and the part of those qualifications, of course, are that they had to be legally married and occupy the property together, not only at the time they did the loan, but at the time of the passing of the borrower. They do not get any ongoing benefits. So if there's still money in the credit line or monthly payments going to the borrower, those will cease because, again, it's a non-borrowing spouse. They do get to maintain and live in the home without the P&I payment. And of course, the balance will continue to negatively amortize, but there is that protection. Any special requirements or restrictions on HECM to HECM refis? It's got to be a true benefit to the borrower. We'd like to see 12 months have passed. There's certain things in place to keep these loans from being churned. There's got to, in California, well, they have to get new counseling regardless, but if they don't meet those benefits, the counseling is required. But typically, we want to see a reduction in overall rate. We want to see, more proceeds going to the borrower. So there are some requirements, but again, it's a case-by-case situation. We talked about the jumbos a few times. I'm going to leave this one for you, Chris. If a borrower went into a real estate investment agreement or shared equity product, is there any man, I can't speak today. Are they prohibited from using a HECM to get out of that agreement as long as they qualify for the HECM? And the only answer I have is, the shared equity entity has to be removed from title, but I don't know if there's any other restrictions there.
No, because the fact there are no payments required, Now, let me say, I have not seen one come across my desk yet. I anticipate they are coming, because that equity release product has gotten more play over the last really 3 years, and continuing to grow. So I haven't seen there's nothing in the guidelines that would prohibit it. I just haven't seen one to tell you, here's the gotcha. And it could be the payoff, that shared appreciation at exit. I just haven't seen one. But no, simple answer, in the guidelines, there is no prohibition.
Yeah. Again, the slide presentation, I'm sure you could email Camp, but also you could just email us at sales@reversemh.com, and we will get you a copy of that.
We will also post it on our YouTube channel within the next couple of days. So,
all right.
So what you're saying is I got to get this posted to the YouTube channel in the next couple of days.
Looks like you got a job to do. But as far as the actual PDF of the presentation, you can email us directly at sales@reversemh.com, and we'll get you just a copy of that. It won't be the video of this, but it'll be the presentation. this I always love this question. What is an average percentage cost to get a reverse mortgage loan? So one of the major differences in a standard FHA, we'll stick with FHA for now, and a HUD HECM, is all the closing costs that are based on the loan amount on a standard FHA are now based on the value on a HUD HECM. And of course, the age determines how much the borrower gets. So their age does not really have anything to do with the closing costs. So if you have a $500,000 house, for example, and a younger borrower, they might only be getting, 180, 200. If you have an older borrower, they might be getting 50% or higher, in loan to value. But those closing costs are based on the value regardless. So using that as an example, you're looking at, right up front, the upfront MIP being 2%. So on a $500,000 house, you've got a $10,000 upfront MIP. You have your origination fee that goes to your company. Lender's title insurance, that's also based on the value. The other closing costs are fairly standard. So I put 10% plus or minus in there, but that's based on how much money the borrower gets. But as I just mentioned, depending on age, it may be a higher percentage or a lower percentage. So unfortunately, there's no exact answer to that question.
But let me also say real quick, and I know we're running on time. These loans are not TRID, as I stated earlier. So they are, they're not a high cost test per se. And HUD and CFPB and all of them, the reason they did that was exactly that, because it's a unique loan. So they're not subject to TRID and high cost testing. So otherwise, if you look at a lot of them, they'd be very high cost loans just because of the MIP.
Got a few more and then we'll be done. What's the rate? Again, the actual accrual rate or interest rate is based on the 1-year CMT, 1-year Treasury, which is currently 3.49. So depending on the margin, that actual interest rate today would be anywhere from 4.8 up to right around just a touch over 6%. Again, that's the physical accrual rate. But as the index moves up or down, that rate's going to move up or down.
Yeah, but we're consistently on actual note rates. We're a high note rate right now is about 6.25 is a high note rate. Most of them are under 6.
Yep.
Well, and we can control the margin a little bit by what we're getting back from you as the lender, correct?
Absolutely.
Most certainly, and that gives you the flexibility to work with the borrower, as you see fit. For those of you that were in the business prior to the 3 lovely rules that we have to follow, TRID, QM, and LO comp, these are harken back to the days prior to that. So you get both origination and yield spread on the same file. And by having the options of the margin, you control that and you can choose to get the flexibility of higher yield spread, maybe helping out with the closing costs, reducing the origination fee, any combinations of those things. Last questions, we went over that. Someone asked about information on the growth of the line of credit. Again, email us at sales@reversemh.com. We have a couple items we can send you that'll go into greater detail on that. I love this question. What is the best way to learn how to become proficient with reverse mortgages? Are there detailed how-to training, certificate programs to become competent? And if so, what would you recommend? I would recommend attending all the trainings that we offer. We do little 1-hour sessions, kind of like this one, go into the various moving parts of the HECM, moving parts of the process, underwriting, working with real estate agents, working with financial planners, best practices. But over and above that, there are some certification classes out there. I don't know if they really offer anything.
NAM. NAM has a certification class, which I am certified in, so I'm going to talk about that. But you are exactly correct. These type of presentations, the type of stuff that with your support that we can do at camp, are often the best ways to get the information you need. NAM only started offering the reverse mortgage class 2-3 years ago, our certification 2-3 years ago. So, you know, the way to learn them historically has always been the presentations from the different lenders, and they're a great resource for you.
Yeah. And one last question. Age is based on the youngest borrower. That's absolutely correct. And back to what Chris said about the non-borrowing spouse, that non-borrowing spouse does get protections if the borrower were to pass, but the offset to that is we have to use that younger borrower's age to determine the benefit. But that is it on the questions. So
Fantastic.
certainly appreciate you guys letting us do this presentation for you, and ideally everybody on board got a lot out of it.
No, and we can't thank you enough. Is Don was on earlier, correct, Dale? But I don't see him now.
Correct. He's gone.
Yeah. So Don was on earlier. Don is the camp education chair, and we're talking about certifications a little bit. So watch for some certifications that are going to be coming from camp. We're going to offer some education on some different stuff, and we'll be putting together a designation type of certificate or something along those lines. But we've got some interesting ones coming: investment property, some tax, and even some possible escrow classes that we'll be putting together, that people can get designations within those proficiencies. So we very much appreciate your time today. And Dale, anything from you?
No, I'm all good. Thank you so much from the Money House. We appreciate it. Great presentation.
Absolutely. And watch for camp has one piece of legislation, but 3 initiatives that we are in process with here in California. One for the broker activity report, which we are directly putting together a committee to work with the DRE at their request. One with regard to HOA fees, and one with regard to trigger leads legislation here in California.